2019 and I am disposing the asset on October 2023. Now, what is the policy? Full depreciation in the year of purchase. So, in 2019, they would have calculated depreciation 100%. Now, coming to the year of disposal, they will say that full depreciation in the year of purchase and no depreciation in the year of disposal. So, what you do? In 2023, how many months asset is with you prior to disposal? Prior to disposal, how many months? You sold in October. So, if you had sold in October, how many months? Let's say 31st October. So, 10 months the asset is with you. Yet, we will not calculate depreciation for that year because the policy says like this. Policy number 1. Policy number 2 is the right opposite of it. No depreciation in the year of purchase and full depreciation in the year of disposal. In that case, 2019, I purchased the asset in November. Asset is with me for 2 months, but I will not calculate any depreciation. And in the year of disposal, I sold the asset in October. Asset is with me 10 months, but still I will calculate full depreciation. Method number 2 or policy number 2. Third policy, on an actual pro rata basis. In that example, what I told you, 1st of July 2023, you purchase asset, you calculate depreciation for 6 months. Is that clear? So, those two complications might fall in place when we completing this. So, disposal is like this. Is that clear? So, with that, I can move on to the next important aspect of IAS 16, valuation or revaluation. Can I continue? Any question before that? What is the logic behind revaluation? Why should we do that? If the market value is significantly varies from the book value, when I say book value is net book value or the book value would mean what is the carrying amount. Book value or same meaning. No, net present value is something else. That is something to do with the time value of your money. Discount factor comes in there. The word net present value has got nothing to do with this. That I would add something called net book value, but not net present value. The net present value is something else. So we will not discuss that. So here, these three, same meaning. What is the meaning? Cost minus accumulated depreciation. This is the carrying value or carrying amount or book value. Usually standard refers this word, carrying amount. If you happen to read the standard, I believe you are very good in reading those. So you will find this word carrying amount more than book value or net book value. But in day-to-day practice, we use these two terms. So that is this. So coming back to the argument behind why should we revalue, if the market value of a given asset is significantly greater than the carrying amount, then that asset is recommended to revalue. However, there should be a management policy. The management should have a review of the carrying amount of the assets on a regular intervals. Doesn't mean every year. It could be every year, every 2 years, every 3 years, like this. On a regular intervals, you have to carry out a review as to what is your carrying amount and what is the market value. This also relates to another standard here, the impairment. Sometimes the market value may be significantly below than the carrying amount. Then the story is different. So when I will discuss impairment, I will go into the that extent. But here, what we happen to perform is to see if the market value is much bigger than the carrying amount, then it is advisable for you to or allowed to do a revaluation according to IAS 16. This is the reason behind why we should carry out a revaluation. Now, how to do that? So what happens is you have to bring independent professional valuers. Now see, the managing director one fine morning comes in, says that, okay my friend, revalue this to 100 million. Is it acceptable? Okay, it is okay, you will do it because the MD says. But the auditor comes in, and if the auditor also, okay, yes, naam habibi maafi mushkila, then if he signs it, kalas. It's a problem. So, if you had to perform, if you had to justify to your shareholders that this value is in fact increased, bring an independent third party, independent professional valuer. He should be a qualified person and he must be independent person. But in some cases, it is also they bring an argument on this. It is not necessarily 100% independent, yet if he is a professional person who can carry out the exercise and he keeps the independent to a great extent, may not be 100%. So, however, he comes and he performs based on his professional experience, knowledge and judgment, he comes up with a value. For example, building. The value of the building, those people only can assess. Now, the building was constructed 50 years before. Now, what is the value? The land, already historical cost is 5 million. Now, how much? This exercise they need to perform. Anyway, someone comes up with the market value. Or I would also add the word fair market value. Here, we can also relate one more standard, IFRS 13. What is fair value? What is fair value? I will bring one scenario here. This is me, Mr. A. I have a car, a beautiful car. See? A beautiful car, right? So, I want to sell this car. I have two potential buyers. No need to draw the car, don't worry. So, one buyer is a third party who is on the market, who is just a random person. Another buyer is my sibling, my brother. So, I have a car, I need to sell this, and I have two potential buyers. One is a random person whom I don't know personally before, and the other one is my own brother. The car market price is 10,000. Approximately 10,000 will be a reasonable price. Now, both of them are approaching. Now, if my priority, if I to sell the car to my brother, I would end up asking him 2,000. Whereas normally I can find a price for 10,000, but I would ask him from him 2,000, but from him 8,000. Now to talk about the fair value, a value agreed between knowledgeable willing parties. The both party must be knowledgeable, meaning the knowledge about this car, whether there has been accident, whether the chassis is good, whether the engine is good. This knowledge must be there for both parties, the buyer and the seller. And secondly, willing parties. There's no one is under any compulsion. I'm coming up with a gun and then point blank on your forehead and then tell you should buy, otherwise I'll kill you. So it should be knowledgeable, willing parties. The value agreed on an arm's length transaction, arm's length basis. So what I mean arm's length, this is the distance, this is the radius. Now what do you mean by that? On the road, someone is walking in. Can you hug everybody? What will happen then if you do that? They will call the police, khalas. So you are only having limited people whom you could entertain within this radius. Am I right? So in this example, my brother is a person with having a beyond arm's length relationship. A value that you can arrive to keep the people at that distance is what the value which I mean fair value. This fair value definition has went on to several changes, and the recent update has brought in by IFRS 13. That is the